In an earlier episode, I made my first trades on Robinhood, but let's step back and try to figure out why the online brokerage firm is so popular. Online trading is not new. Roughly 25 years ago, a slew of online brokerages like E-Trade emerged, letting people trade on their home computers for a fraction of what traditional brokerages charge.
I like to trade online.
You give a kid a computer and he thinks he can beat the market.
The sites even had flashy ad campaigns to appeal to a young generation of home-based, tech-enabled traders.
This Christmas, everything is getting blown up. This movie's gonna blow. A Triumph Studios production.
But over the last decade, those traders felt they were losing out to moneyed hedge funds that were better equipped to seize upon and perhaps even create their own trading opportunities. In fact, just 3 years ago, the Wall Street Journal reported that 80% of daily trading volume in the US was computer-generated and based on algorithmic models. Then, in 2015, came the Robinhood app, offering what it called free trading and empowering a new generation of traders. As we saw in previous episodes, registration was easy, as was making my first stock purchase. Also, in the time since I've opened my account, I've been flooded with alerts on how my portfolio is doing. And although I was skeptical about the hype, I have to admit, it's made me eager to log in. Of course, nothing, especially in the world of finance, is ever truly free. While traders may not see fees on their trades, Robinhood is actually being compensated by payment for order flow. When you place a trade on Robinhood, in the background, market makers like Citadel Securities and Virtu are paying brokerages like Robinhood to execute the trades. These market makers make their money by buying the shares for less than they sell them for moments later. Roughly 80% of Robinhood's revenue comes from payment for order flow. To the blind eye, there's not much to see, but regulators and others worry that these compensation arrangements aren't clearly spelled out and that retail traders may not be getting a fair shake. In August, SEC Chair Gary Gensler said the agency is reviewing payment for order flow and eliminating it
is, quote, on the table.
And then at the Milken Institute Investor Conference in October, market participants speculated what would happen if payment for order flow went away. According to Joe McKean of Citadel Securities, the market makers would actually make more money because they'd no longer be paying for flow, and brokerages would likely have to resort to charging fees again. In the end, the debate may just come around to transparency. Either way, I want to test it out. No, I am not doing dueling laptops or dueling pianos here. I am going to do a little experiment where I am going to buy the same amount of shares of the same stock at the same time on 2 platforms. My Robinhood account over here, my Fidelity account over here. I'm going to go with Smile Direct Club. Now, Smile Direct Club has been the weakest performer in my portfolio. It's down around 40%, but as they sometimes say, buy the dip. So let's see if maybe I can lower my cost basis, maybe catch some upside on this stock. Robinhood is showing that Smile Direct shares go for $4.03 right now. Fidelity is showing $4.02. Fidelity has a disclosure that its quotes can be delayed by at least 15 minutes. I don't see that disclosure on Robinhood. Doesn't mean that there isn't a delay there. So I am going to do my best to try to execute these trades at exactly the same time. Maybe this pointer is a little bit stronger than this one. We'll try my best. Let's line this up. Okay, the trades have been placed. So on my Robinhood side, it is showing a market buy of $20.14. Now on the Fidelity side, I am seeing $20.15. So we're looking at the difference of a penny. Not a big difference. A penny doesn't really add up too much. But if you're trading thousands of shares, millions of dollars, those pennies or even fractions of a penny eventually do add up, raising questions about who's getting the best execution for trading. As for me, we'll see where my shares of Smile Direct end up. Next time, we'll take a look at what regulators think about the meme trading phenomenon.